I invested nearly $10,000 in one single stock. I'm going to break down what it is and why I did something that is so risky in a way. So let's go ahead and break it down. PCAR, PCAR is the stock symbol here. I like to call it PACCAR. I could be pronouncing it wrong. It is what it is, but it's my company because I own it, or at least a small share of it. Y'all get the point. But let's go ahead and break it down. So they are a manufacturing company. They make the Peterbilt trucks as well as Kentworth, these large semi trucks that get everything from point A to point B. There are several reasons why I decided to buy this stock. I will tell you this. I say this in many of my videos and continue to say this, whether it's crypto or individual stocks or what have you. I think that you should limit your investments to your single investments, one company, one cryptocurrency, whatever it is, to 5% or less. That's to protect you in case you are wrong, okay? So that you don't put all of your money in one single investment. So for me, I'm still following that rule in this particular instance. But it is my largest single stock holding that I currently have. So this was a relatively big risk for me. So why did I do this? What I want you to do is not just don't invest in this company just because I said it. Don't do that. What I do want to do is take the mindset, take some of the things I'm looking at, copy it, and paste it to your portfolio, not necessarily the stock, because your risk tolerance might be different than mine, okay? But the mindset, the things that I'm looking at, can apply to whatever it is you're looking for. So I took a look at a few things. The first thing, as always, I'm always looking at performance just to give me a lay of the land. 12% in the last 6 months, about 45% in the last year. Perfect. Okay, very good, very solid. It's not Nvidia, okay? It's not some of these tech companies, but it's solid. And I actually like the fact that it's not in the tech space. There's nothing wrong with the tech space, even though it's extremely hot. Sometimes I just like to shoot for the middle. As I've said, I practice what I preach with my investments. I like to shoot for the middle because if AI is a bubble, which I've mentioned before, I don't have to worry about that with this particular company because I'm not really in that AI space. But performance was one thing. The next thing that I noticed about this company is when I start to look at its finances, they have grown their financials, their free cash flow, the money they have in their hand, it has grown by 26% on average. On average, 10 years of 26% growth on average. Now, that's already good. Okay, imagine your salary growing at 26% a year. Okay, that's already amazing. But what I did is say, look, what if I'm conservative? If you have actually been growing at 26%, let's say that I assume that you're only going to grow 8% in the next 5 years, the next 10 years. If that is the case, again, this is me being conservative, then the stock is worth about $108, which at the current time that I'm doing this makes the company undervalued. Okay, now I'm not even taking the actual number. I am lowering that number by more than half and taking a look now, and it is still undervalued. So that's one reason why I bought it. There's a performance, they're undervalued. And then I tell you right now, I saw insiders buying this company. Now, I didn't see with my own eyes. I looked at a website that had a form that said that they were buying. And what insiders are, these are the CEOs, the CFO, all the bigwigs that make the decisions at the company. The reason why that is important is because there's only one reason why people buy, and that's because they think the stock is going up. What we have found, there's a Harvard study done in the early 2000s that showed that when insiders buy, they perform a minimum of 5% higher than the stock market. If the stock market gives you 7%, they are getting you 12 from the time that they buy. There were several insider buys in the last quarter, the last 3 months. And once I saw that, I said, look, insiders are buying, your finances are solid, the company's moving in the right direction. You know what? I think there is time. I think it is time for me to go ahead and hop into this company. So those are the primary reasons. But there is something that is let's call it a bonus here. And what I've been doing is a more advanced technique. Okay, I want to emphasize it's a more advanced technique called covered calls. And what I did was buy 100 shares of the company and I'm selling call options. I'm going to break down what call options are, but if you want to learn more, I've done an entire video on it. I'll make sure I link to that at the end. But what this is let's say I bought stocks bought PACCAR at, let's say $97 per share. Okay, if I bought it at $97 a share, I can sell a contract that says that I must sell it at $100. Notice I bought it at $97, but I must sell it at $100, assuming it gets there, to someone else, whoever buys that contract. But here's the thing: if I am selling a contract, that means I am receiving some money, right? So what I'm doing is selling these contracts every month. I'm getting paid by getting these contracts and by holding the stock. And in the worst case scenario, the stock goes up to 100 and I have to sell it. Now, the reason why that's not great for me is because I do like the company. I would like to keep it long term. But if I have to sell it for a profit, hey, I get paid. Right? I got paid. That's the most important thing for me in this instance. But the reason why it continues to work is what I do is if I buy it at 97, I don't know if it's going to get to 100 by the end of the month. So what I do is say, hey, look, I'm going to sell a contract at 105, a number I don't think it's going to get to. I'll sell the contract. Stock goes up the next month, instead of selling at 105, I'll sell a contract at 110. I'll continuously push it out so I can get paid from these option contracts while still holding a company that presumably continues to grow at the rate that it has been. There's no guarantee that the stock is going to continue to grow. There's no guarantee that these shares won't be called away. There's a risk because if it's a long-term investment that I love and somebody buys it for a higher price, yes, I would have made my profit, but I would have lost that stock. So that is the risk here that you do want to understand if you do a strategy. I'll do this particular strategy. I will tell you this, if you are new, this is the first strategy you should try. But if you're new, I don't think you should try option trading until you're at least 2 to 3 years into understanding investing as a whole. That's just my view, okay? That's just me. Maybe I'm a little old school or whatever, but that is how I would approach it. The other downside that you should know about any cover call strategy is that you do have to own 100 shares. I don't know about you, but when I started investing, I had $10,000 to spend. That would have been all I had, okay? So it did take me a while to build up, enough cash to buy a company I wanted to buy. Okay, I didn't, there's a bunch of companies I could have bought 100 shares of. I just don't trust those companies are good. Okay, so I wanted to choose a company I thought was good, that was solid, and this checked all the boxes from insider buying to performance to financials and obviously what they do. They're in a space that is consistently growing and is likely going to continue on that path. So that is how I looked at it. But if you are looking for other option strategies that are out there and what our options are, if you're confused by that, then this is the video I want to check out right here.